Hey there, I'm Pete Townsend, and this is Money Never Sleeps. We look inside the minds of entrepreneurs and at the crossover of startups, enterprise, finance, technology, and life as we know it. In this episode, Eoin Fitzgerald and I take a look at the aftermath of the American Bankpocalypse, with contrasting views on Bitcoin as a safe haven, and how a potential outcome of Grayscale's lawsuit against the SEC may be opening the floodgates of crypto into institutional finance. We also dig into the $600 million raise by open banking startup Abound, and how a new EU regulatory framework around AI may slow down not only Abound's AI-powered consumer lending platform, but also the overall commercial growth of AI applications in Europe. All right here on Money Never Sleeps. Hey, Eoin.
Hey, Pete.
How you doing?
How you doing? Wonderful. Yeah, sun is shining.
How was St. Patrick's Day anyway?
It was fine. Like I mentioned to you before, my kids have had chickenpox last week, so we didn't really go anywhere. Yeah. Didn't watch any parades, nothing. I wouldn't have said it was overly exciting, but sure, look. We had a good weekend, watched the Ireland match, obviously.
Yeah, that was big. That was big. Yeah, I was very excited all St. Patrick's Day, just waiting for Saturday to roll around for Ireland versus England. Yeah. And for those listeners outside of Ireland that are not aware, Ireland won the Six Nations tournament, Grand Slam, undefeated all the way through.
At home on Patrick's weekend.
Yeah, you can't beat it. And, probably Johnny Sexton's last Six Nations. So it was a big deal. Friday wasn't... It was St. Patrick's Day.
I'd say a lot of people went easy knowing that they had Saturday.
Well, I mean, having kids that are now walking in the parade, not just going to the parade, but walking in the parade, it's like, okay, you hang out and you basically walk a mile through Stepside Village. And that's about it.
That's it, yeah. You could do that walk any day.
There's a fun fair on. We went over to a friend's house for dinner afterwards, and my buddy Meso made a lovely curry, and we had a good time, and then went home later on. Cool. So yeah, that was about the size of it. But keeping my eye on weekend activity. This weekend, obviously, this past weekend was a lot different to the weekend before because my phone wasn't buzzing every 10 seconds with a new update on Silicon Valley Bank or any of the other bank stuff that was going on. So that was nice. But there's been some interesting reflections that have come up since then. I know we said enough ink has been spilled on this, but there's a lot of analysis that has taken place on what happened with, what did I call it? The Bankpocalypse. We did an episode last week. And it's pointing to some longer term structural things that have been quite interesting. And I talked to a number of people who over the weekend that when USDC depegged, which is the stable coin USD that Circle run, that when USDC depegged, which means it broke the buck. So a stable coin has some similarities to a money market fund. And when a money market fund breaks the buck or goes below $1, that's where there's problems. And that's what's happened to USDC because $3 billion in assets were at Silicon Valley Bank because the USDC is fully backed by cash and or liquid instruments. So when that depegged, people are like, well, what am I going to move my USDC into? Because that is the safe haven asset. They moved it to Bitcoin. Right?
Yeah, it's interesting.
It is. And I nearly did myself. I saw the fates of USDC over that weekend being tied to the fates of Silicon Valley Bank. And as things slowly turned the tide towards Sunday night with a Washington Post article, it was like, okay, I'm not going to take any rash action here and do anything to lose 10 to 12% of my USDC value. And, there's an upside on Bitcoin, but guess what? If I wanted to keep it in Bitcoin, fine. But then if I wanted to move it back to USDC, I've got tax, right? That then I got a tax impact because that can be a capital gain. Or if Bitcoin had gone down, that was a different thing. But interesting article in Reuters that says Cryptoverse, Bitcoin passes the bank stress test. And it's talking about this exact context of people moving that over that weekend, that not only was it just USDC, it was fiat currencies where people were saying, what is the safe thing to do here? Well, we're going to put it into Bitcoin. And what's happened to Bitcoin over the last week? It shot up 15%, 20%, right? So I anytime that I talk to anybody about, the inflation hedge that Bitcoin purportedly offered, over the last few years, that I said, listen, I need a whiteboard to really have that conversation, and I can't do it justice. But largely what's been proven is that that inflation hedge just didn't work. But now, is this just a short-term thing where Bitcoin is viewed as a safe haven asset, or is it more of a sign of things to come? It's an interesting one that I think economists are going to be left scurrying about the floor on.
Because there's been some great articles and kind of commentary out there around, trust and trust issues and stuff like that. And it's I suppose it's ironic in some ways that the solution when you don't trust your bank is Bitcoin.
Yeah.
But then you want, to me, that's not the solution. But at the same time, people genuinely seem to have trust issues about the banks in the last couple of weeks. And obviously with the Credit Suisse news, it's continuing on, and there's that risk of contagion. I think Janet Yellen in the US was only interviewed yesterday at some event talking about, they will step in if there's a contagion risk.
Yeah.
And they will. So that backstop is always there, clearly now. But still, it's the idea that, I don't trust my bank anymore. I'll move my money into Bitcoin, which, can't necessarily trust because it's designed to be, obviously trustless to some degree, but it's hard to see it being the answer. It's the short-term immediate answer. But
it's not the answer right now. It is still too young of a currency. I used this example before. I'll use it again. The dollar in the 1870s, right? There was so much stuff going on in the Wild West that it was hard to really say, this banknote that says it's $1, am I actually going to get $1 for it? Right. And, so because of external factors, but Bitcoin, when you pull away all of the layers of intermediaries, it's crazy that I'm talking about that in crypto, but intermediaries, when you pull away using passwords rather than seed phrases and private keys, when you pull it all away, you are your own bank. You're holding it yourself. And if you can do that and stomach the technology risk, but also then stomach the volatility risk, then it is an example, because it's the code that you trust rather than the actual intermediary or the bank, and you're trusting yourself.
And I suppose people were worried in the US that they were going to not get access to their money, make their mortgage payments, all that sort of stuff. But, moving it out to Bitcoin didn't answer that question. You just got it out of the bank.
Yeah. And so when you step back and you look at all of this from a real world perspective, would mainstream consumers say, oh my God, I'm in a bank that is not, and all my life savings are in a bank that are not a top rated bank. I better move. What am I going to do? Am I going to go open up, get my own, hardware wallet, a nano ledger, and pair that with a MetaMask wallet and hold Bitcoin there? Right? Is that what I'm going to do and get out of fiat? No. Right? I'm going to move it to another bank if I'm actually that scared about it.
Or you might spread it around a few banks.
That is mainstream consumers, right?
Yep.
And I heard this morning on a podcast. I did what you did this morning when I'm out for my walk. I'm like, I just went to Invest Like the Best, flipped up my thumb and said, where am I going to land? Okay, Gabriel Layden, September 2022, a great gaming mind that is in Web3. And he's like, there are 60,000 daily active users of wallets that hold NFTs right now in the world. Tiny. So when we talk about mainstream consumers, are we talking about people going into digital assets as a safe haven? Absolutely, freakily, notly, no. So, but in the case of more and more institutional finance, more and more that level of wealth above family office and before you get into the small institutions that are actually providing services in crypto assets, providing investment solutions in crypto assets, where they may be perhaps holding a quantity of USDC in wallets. Would they perhaps have moved out of USDC into Bitcoin last weekend? I would think so. Yeah, it's definitely possible. If you're educated and you're informed in this space and you're actively using it as part of your wealth management, yeah, it makes sense. So it's not a short-term trend where we're going to see this mass adoption, but it is just one more sign of what's to come ahead of us. And this, I know it's a little bit of a different arc, but this guy, Gabriel Layden, is like, listen, the best way to get people onboarded into crypto is to just give it away. right? And that, and his latest thing that he was talking about in September of last year is what's called free to own, right? And it's digital assets that you are given. So NFTs that are representing a character, an avatar, a sword, or whatever. When you're playing a video game, it's just given to you in a wallet. And then it's free to own. So it's not free to play. It's not play to earn. It's free to own. And you get into this space of, okay, you are now holding a digital asset because you've opened up an Ethereum wallet in order to hold this digital asset. So you're now in crypto. And you're actually using these assets because you're using them in games. So you look like a daily active user or a monthly active user for that purposes. So,
and we've talked loads about the volume of monthly or daily active users in the gaming space.
Yeah.
Like it makes total sense to be given away or to kind of under the radar onboard lots of people into the idea of crypto and the adoption of it through gaming or whatever.
Yeah. So, I don't know. I feel like I'm on a soapbox right now. So I was having lunch. I was having lunch with someone yesterday who I hadn't talked to in years. And, he's like, so you're in fintech. And I'm like, it's kind of my entry path into everything I'm doing right now. And, that is going to be my first love, right? But I'm doing, that's just one small piece of kind of my inspiration here for the investment journey I'm on. And he said, well, tell me how you feel about crypto. And I'm like, I was kind of caught off guard and I didn't get up on my soapbox. I was just having a chat with him about regulation and a few other things. Because he was saying, listen, he's getting into the advisory space after a long career and he wants to, he's a big fan of crypto, and anyone he talks to in the advisory space in Dublin, people have been around for a while, like, oh no, we can't do crypto. And it's like, okay, what country are we in? What year are we in? And I didn't go up on my soapbox, and I'm just like having a chat with him about regulation and about the US and Europe and that type of stuff. And I mean, it was a good conversation anyway, but no, I mean, I think this is, again, a trend, something that happened that people have made some sense of and pointed to perhaps some longer term trends that I know you and I will both keep an eye on.
Yeah. And look, like that, for the moment, or even in the context of what's going on, it represents another place to put your money if you're worried about the bank, whether it's in gold or whether it's in Bitcoin or whatever. It's just another option for the time being. What that means longer term, we'll see, but it doesn't necessarily mean Bitcoin is the answer. Like you're seeing a lot on Twitter and everything. Oh, the banks are terrible. Like, because the reality is it's not that. Like I said, to the mainstream consumer, it's not that.
Yeah.
But it is another place to park some money if you have a worry. That's diversification.
It is. The experience needs to get better though. And I even going on to MetaMask, which is the most widely used wallet. And you can now, through Apple Pay, buy crypto through your MetaMask wallet, right? Yeah. And that experience of going through that, you're connected to like 3 or 4 different fintech utilities in order to make that one transaction happen the first time. You got to sign up on this other, on this other app. And it's like, I'm not going to do it. I just, I tried out the experience and I'm like, let's keep buying through Coinbase and then send it over to my MetaMask wallet directly from there, right? For when you actually want to use a Web3 wallet. Coinbase have a Web3 wallet now, but the MetaMask is just more widely accepted. So anyway.
I thought what was interesting was obviously that the follow-on from SVB was obviously Credit Suisse over the weekend again.
Yep.
They love to do these things over a weekend.
It's the best time for bank failures to happen,
Yeah. And look, I mean, again, there's been loads put on it. I thought it was really interesting when both parties announced it. UBS announced an acquisition and Credit Suisse announced a merger.
Yeah.
Which was funny. But Simon Taylor tweeted something over the weekend, which I thought was interesting. It was the Bank of England came out with a statement, I don't know if you saw it, clarifying their view on equity and debt holders.
I didn't see
it. Like at the very bottom of their, like it was a very short, half a page statement. And at the bottom of their statement, they mentioned that they welcome the steps being taken, obviously, to support Credit Suisse, etc. But they went to great lengths to quietly clarify that they believe that, debt holders should be made whole and equity holders not. Because obviously the big part of the Credit Suisse deal was that equity holders were looked after and the debt holders were left out hanging to dry. So it's just interesting that the Bank of England came out to clarify that that's their view.
That equity holders are first?
No, that debt holders are first.
So when you issue debt, then they're your creditors and you need to pay them back first.
Yeah.
And then an equity holder. Yeah. And then you have subordinated debt, right? Which goes below that.
There's all levels of debt.
And then it's equity after that.
Whereas it seems like obviously the deal for Credit Suisse was the reverse. Equity holders were looked after
Oh,
first.
that's interesting. I got to look into that. I
Hmm.
got to call my finance professor from college and say, what do you think of this?
Yeah. Yeah. So it was just an interesting, like, as Simon Taylor, I think he said, or whatever way he worded it, was around, a massive quiet statement from the Bank of England. Nobody asked them to say anything, but here's their statement on
Yeah.
what their view is.
Yeah. I kind of
So,
wish the SEC would make some statements here, but I think it's, this next story really points to the need to do that with
yeah,
Grayscale has sued the SEC. So Grayscale are the operator of GBTC, which is the Grayscale Bitcoin Trust.
yeah,
And that is operating as a trust, and they have applied to convert that into an exchange traded fund. And the SEC said no in June of last year. And immediately, Grayscale filed a lawsuit and said that the SEC was acting in an arbitrary and capricious way, in that
yeah,
there was no basis for this rejection. There are currently Bitcoin futures ETFs. So ETFs, again, exchange traded funds that are kind of viewed as regulated vehicles because they follow the Investment Company Rules Act that enables mutual funds to operate, and that those are then overseen by the SEC. So if you bring a Bitcoin ETF to market, that is then seen as a regulated vehicle, and that institutions that can only invest in regulated vehicles are able to invest in a Bitcoin ETF, right? Rather than buying Bitcoin directly through a centralized exchange or through a decentralized exchange and holding
yeah,
that separately with a crypto custodian or even through their own self-custody wallet, right? So the compliance controls, procedures, risk management approaches said, listen, let's just invest in a regulated vehicle, right? If you're a big pension fund. So that's now starting to gain some momentum, that lawsuit. And there has been some, what do you call it, precedents in the past for these types of lawsuits where
yeah,
if Bitcoin futures are allowed to be packaged into an ETF, they are using the same exact reference asset that is being proposed as the asset to be held in it as a Bitcoin ETF, and this ETF by Grayscale. You have no basis to say no.
yeah,
The SEC is pointing to a couple of things that I think, or if they're not pointing to it, I'm kind of thinking it, because people have, because I've been in this space for years in terms of how do you actually safekeep an asset. And I think that's one of the concerns, is that how will these Bitcoin ETFs ensure the safety and safekeeping of Bitcoin? Will that be held through a crypto custodian? Will that be held through a self-custody wallet? Most US custodians that are big custodians used by mainstream ETFs, they don't have crypto custody offerings.
yeah,
BNY Mellon are kind of coming up the curve a bit, State Street, whatever. You start hearing stuff about that. And it's the crypto custodians that operate under trust company licenses out in New York that are the ones that are providing the majority of custody services. So Canada, it has already approved Bitcoin ETFs, and the two main custodians used by those, if either directly or as sub-custodians, are Coinbase and Gemini, right? And so I think that may be one of the things I haven't read that the SEC is pointing to this, is that how do you actually ensure the proper level of safekeeping of these assets as an ETF? All right.
yeah,
And there's plenty of controls and procedures that you can point to that Grayscale are using today that will be totally applicable to this purpose. I think one of the things the SEC may be thinking about as well is that they don't actually, the qualified custodian rules in the US for who can actually hold assets on behalf of registered investment advisors, that those qualified custodian rules need to be adapted for crypto. And was some 434 page publication on this recently that I did not read, but that talks about this. But it sounds like there's just a few more bells and whistles that needed to be added to the qualified custodian regime for this to actually be viable.
yeah.
So that's the only thing I can grasp at here, outside of a politicized call within the SEC that says, sorry, Gary says no.
And you know what? From the outside, it strikes me that this is too political, and this is just another thing that's kind of got caught in the crossfire. You know, there's a need and a want to regulate, and they're not there yet. No different to like the Mika thing coming in here, but it's not going to be in for another year at least. There's I think they're probably just trying to slam the brakes on a number of things ahead of time so that they have time to kind of fix things in the background.
Yep.
And that's why you'll see companies suing. Like, it happens, with government agencies around the world, is that like people would have to sue to get something that they're entitled to or whatever.
Yep.
It seems to be the same idea.
Yeah, definitely.
And like you look at it here, obviously we've got Mika coming in next year at some point, and there's the vast regulation here on the ground in Ireland. But at the same time, that's slowing down a lot of business because people are spending a lot of time trying to get approved by the central bank. But like that, there's probably an element of there's actual regulation coming in the near future. Let's not be too hasty with letting things through now, in case it changes drastically in a year's time.
Yeah, but it's like I'm kind of sensing some of the 2007, 2008, 2009 rhetoric around hedge funds. Hedge funds were unregulated vehicles. There was a lot of Wild West stuff going on back in the early 2000s on that. Regulation came in 2009, 2010 with AIFMD and other updates in the US. There was this President's Working Group on Hedge Fund Standards in 2007, 2008 that was a precursor to a lot of that regulation where people were making these statements. I'd say there's so much of that stuff going on in crypto right now among the the top tier players of these standards. And they're
just trying to slow everything down in the meantime. We're not going to let Grayscale through, or we're not going to let the next thing through because we're trying to figure it out in the background.
Yeah, and it's going to be interesting to see what happens with this lawsuit, because Grayscale are suing the SEC, and they will, if it gets denied again, they'll go to the Supreme Court, right? And they're prepared to spend plenty of money on this. I listened to Michael Sonnenschein, who is the CEO of GBTC, and it was terrible. It was like Peter McCormick on What Bitcoin Did. He was on that podcast. It's like, how do you pronounce your name? He's like, and so he said it's like Sonnenschein. It's SONNENSHEIN. And the way Michael said to remember it is that I'm spreading sunshine on crypto. Like, oh God, don't say that again. I can't believe I just repeated it. But they're prepared to take this all the way. So it could set some precedents here. And once Bitcoin is packaged as an ETF, where it is the true physical Bitcoin that is, or digital Bitcoin that is held in a fund, watch out for Ethereum right after that, and watch out for the next top 10 cryptos after that. Yeah. And then watch out as the floodgates open. If you look at institutional asset management, say it's $100 trillion market, if we just get 1% of that into crypto, we're pushing, we're basically doubling the market. Say we get up to 10%, that's 10 trillion coming in to crypto. Okay. Yep. And that next floating of assets into crypto I think is what is going to pay for all these UX improvements, like we talked about a few minutes ago, having to go through all this
adoption, the everything
to make it easier. There are some technological developments happening on the Ethereum network that I won't get into that are seen as a trigger to unlock some of these easier, more enjoyable user experiences with crypto wallets. But, I see that this Bitcoin ETF could open up a huge floodgate of assets into the space, which is only going to make it better and safer. We are still going to have the token flippers out there. You can't stop that from happening. Okay. So there's going to be tons of this, and we're going to see many thousands more, many tens of thousands more. But this will be, hopefully, if once a Bitcoin ETF does get approved, it's going to be, to me, will be the thing that will open up the floodgates.
Yeah. Yeah, no, I agree. Absolutely.
Cool. The next thing does have some linkages to this subject matter that we're talking about, but I know it's right there in your wheelhouse with credit scoring, right?
Yeah, I had two stories, and actually I'll go with the company-related one first, which was, so yes, obviously I'm not shy about the fact that I have a fascination with online lending businesses, having spent a number of years working in one, and especially building the underwriting models. I think that's fascinating. And as I go through a process of trying to get a mortgage, it's both fascinating and infuriating. But yeah, so this was UK-based lender Abound, which had landed a fresh 500 million in equity and debt to improve access to accurate and affordable consumer loans. So debt financing is coming in from Citi and some clients of Waterfall Asset Management, and then equity is coming in from GSR Ventures, Hembro Perks, and a few others. So Abound came out in 2020 using AI and open banking to look at a more complete financial picture and allowing loans without just relying on credit scores, which I think is huge. And like, to me, that's one of the biggest, more immediate opportunities with open banking, is being able to connect all your accounts together and have a fuller picture of your financial history and your financial affordability. And like, it's some of it to me is so obvious, taking into account the fact that you're making rent payments and things like that, should be something that's looked at. So Abound says it looks at lenders that are ignored by traditional banks while reducing the risk of lending. It has about 150,000 customers, 30% month-on-month growth to date. And then it's looking to build out a B2B offering to allow banks and other lenders to leverage its technology, which is a smart move because we've seen that in the US with a couple of the operators there. Stilt was an online lender which rolled out its own technology solution. So that, like I said, I think it's fascinating. It doesn't go into detail about how much equity has been raised as part of that 500, but you'd have to assume the majority of it is debt, which obviously is good because it speaks to them putting more loans in the market. There's a number of players in the UK market, Koyo Loans and a few others, who are in this kind of space around open banking. And I think I saw a report last week from the Open Banking Initiative which said that there's 7 million kind of registered regular users of open banking in the UK now. So they're leading the way from I suppose I'll still include them in a European context from an open banking point of view, but there's a huge amount of innovation in the online lending space happening in the UK market alone.
Oh, big time.
Really good to see, and it creates huge, great opportunities on the back of it. Like, I'm part of the open banking working group here, which one of the kind of run by the Banking Federation, and the players we have in the market here and the work that's being done, it's fascinating to see where it can get to. And obviously being I must find it, and we put it in the show notes. I read the kind of history of FICO, which is obviously the original, most widely known kind of credit score model. And it's about, I think, 30 years old, and it has changed very little in the 30 years. It's still the kind of go-to model, particularly in the US, that people use. And I mean, it's so limited in its range and in the information that's included, but it has been the de facto kind of gold standard credit model or credit scoring model in the US that nobody's willing to change it.
Why?
And it rules out so many people. Like we've talked about an overcredit, obviously opening access to credit scores into different markets.
Yeah.
Even something as simple as that. So there's a lot of people being kind of kept out of the market by traditional lenders for lots of different reasons.
And it's not just in Europe, UK, and US, Western Africa or Africa, right? And I got very excited about this article in thinking about my experience with helping with the Lagos program for Techstars. And I saw so many really cool things coming out of that are enabled by the poor banking infrastructure in Western Africa. And that it's really hard to get a bank account because that's all based on the old school systems of, in order to get a bank account, we need to be able to identify you. And to be able to identify you, we need to know your address, right? And so many people don't have IDs, and that addresses are unmarked, and that it could be 2 hours that you need to travel to get to a bank.
Yeah. But it's also not worth it.
It's not.
People are on $2 or $3 of income a day. Like, it's not worth rolling out your traditional banking and lending model. It needs to be a tech-led solution which can be done incredibly cheaply because the loans are small and the income is small.
So it's mobile money wallets, and anytime someone brings up M-Pesa as an example of what's happening in Africa in terms of fintech, means that they don't really know what's happening in Africa in fintech, right? Yeah. Because the M-Pesa model is kind of a few years old, and that what I was most fascinated by was people's spending activity is all over the place. It's spread between different mobile money wallets. It's spread through different fintech banking apps. And it's that, how do you actually get a good picture of someone's credit history and of their, not even their credit history, but their affordability, their appropriateness as a borrower. And it's, you have to be able to bring all of these data flows together and do that through APIs. There's no open banking yet. And even in Africa, and even if there was, it would be useless because most people don't use the banks. They're just using some type of fintech solution. So when I see this happening in the UK or in, closer markets in Europe with Abound, I'm like, all right, bring it on. And it's happening through open banking, which is a good thing. Yeah. And I'm kind of starting to see this parallel between the race for growth in open banking data flows and the race for those on the more cutting edge of fintech to use stablecoin rails, right? And for moving money. And I think we talked about it a few weeks ago that it would be great to see someone pulling in your Etherscan, which is a public utility where you can look at any Ethereum address and see what their transactions are, right? And where it's going. Anybody could look at that. You can Google an Ethereum address or a wallet address and you can see what the balance is, right? So it, when we see more and more in Western Africa or in Africa in general, of stablecoins being used and the infiltration of stablecoins into that market, that there will need to be some type of analysis done on the spending that's being done and the transactions being done to assess someone's affordability.
And the cool thing is, the great thing, and I'd love to be looking at it more closely in that area, is that you're building it from scratch. Yeah. There isn't a tried and tested model because it doesn't exist in that type of market. And we've given a shout out before to the guys in Umba doing fantastic things in kind of micro lending. Yep. And I know we had meant to get the guys on the show, and we'll have to follow up with that because I'd love to dig into that to find out how, you're building a credit and a risk model from scratch. Like, how do you do that in a market like that where either the data is limited or the information you're given looks nothing like a traditional credit score or credit model?
Yeah. And do you think Barry from Umba would prefer that I give his name the pronunciation of an Irishman of O'Mahony or of an American of O'Mahony?
I don't know.
Let's ask him.
Probably the Irish
I'd
way.
say so.
Let's ask him.
But you put that in
No, we did want to get him on the show, so we actually have to follow up on that, and I'll do that. But it'll be great to really dig into it and understand, like, people doing it on the ground, to see how it works.
So.
But as with our conversation just there on Grayscale, the flip side of kind of the open banking AI lending opportunity is this regulation which is coming down, and I have to pull the article back up on my phone here because it's not working on a laptop, which is about the EU's AI law, which is due to be rolled out. It's in discussion phase at the moment. This was the article in Sifted. So there's an EU proposal. It's still under discussion and will enter into force late this year at the earliest. But it's already giving people working in and with AI in Europe headaches. So it's designed to restrict big tech companies, but ultimately, as with anything else, the regulation will have probably a greater impact on the smaller companies because it'll become more expensive to be compliant. So, some research done by the European AI Association found that 73% of VCs expect that the AI Act will reduce or significantly reduce the competitiveness of European startups in AI. And they won't be able to handle additional compliance. So the Act, it's meant to be the world's first regulatory framework for building AI products. In the idea that the hope will be more widely adopted, like with open banking and PSD2 and a few others, that the rest of the world is starting to take pieces from and roll it out on their own. So it's around solutions that bear unacceptable risk, and they specifically talk things about biometric identification, social scoring, things like that, and high-risk systems. So one of them that's highlighted here is around creditworthiness. Yep. And will be subject to strict monitoring and auditing.
I got so animated when I saw this, right? When you said it to me. I'm like, Owen's finding some damn good ones this week.
And do you know what? Because we've discussed it before, Apple Card, when they rolled out Apple Card with Goldman Sachs, I think. Yeah. Goldman backing Apple, it is. They had, when they did an assessment kind of a year later, they had a massive there was a bias built into it, that, an unexpected bias around, obviously, the males were getting a better kind of credit score and rate than females for the exact same application. And that was something they flagged, and it was a big issue, and I think there were a few court cases on the back of it, and that's a couple of years ago now. So there is a risk of that bias being built into some of these models. I get that. However, the government bringing out regulation around it when we've just talked about the opportunity with AI and open banking to provide better access to credit for people. I think, to me, this could be huge. It's clearly, going by some of the surveys and the reports, this is going to be a huge issue.
Yeah, I didn't even know this was coming. I didn't know this regulation was coming.
I'd heard of it, but not in a big way until I saw that article.
But it's like this classification of the unacceptable risk, the high risk, and the medium or low risk of these different capabilities driven by AI, going from, like you said, what was it, law enforcement surveillance using biometric, biometric
Fair
identification tools.
Yeah.
Okay. And then low risk are like spam and, chatbots.
Like
it's
that,
like, are we really going to regulate that? And I think the positioning of the article in Sifted was to say, well, are we going to push AI to the US? Right? Where there's no regulation around this type of stuff.
Are these companies going to go to the US? Yeah.
Because it's just too expensive. And what's really interesting is looking at some other voices saying, will we drive big crypto players to Europe and outside of the US because of there's a lack of regulation there, but there's also regulation happening by enforcement, right? Yeah. So, and where there is some more certainty on this side of the pond. So it's really interesting to see this juxtaposition between AI and crypto, and all of the craziest VC hype discussions right now that are going on that I've been privy to have been around the combination of blockchain and AI. So it's like, this is right in the flow of all these conversations.
Because I was doing a session, obviously, with the Pat FinTech on fintech ecosystems recently, and I was talking about the European Commission and their fintech action plan. And one of the examples I gave was, in 2018 when they launched it, they rolled out regulation around crowdfunding, which I think is still under 12 months from coming into place. But, it was presented as positive for the market, and it was going to, normalize the activities and the information required across all the European markets. And great, you could argue it's all very positive. But I know from talking to companies in the crowdfunding or peer-to-peer lending space that the impact on the ground was the cost of compliance. And I know from one crowdfunding company that I work with, they said that if that had been in place now, they would have never been able to get started.
Yep.
So I think the same issue is going to apply here. The unexpected consequence of trying to regulate something is you make it too expensive for the early stage companies to get up and running.
Mm-hmm. I know. And at what point does using AI to churn through all of your open banking data, at what point does that mean it's unacceptable risk? And what frameworks does even a Revolut need to have in place? Because the way that they do their BNPL and their credit card risk assessments is through taking all of your bank account data,
transaction data,
and putting it through not someone's hands, but putting it through some kind of algorithm, which is, you can call AI, that makes a decision based upon some rules. So this is, Revolut, the Revolut that I use is based in Lithuania, right? And the Revolut that, obviously the UK use is based in the UK. So this is, I got to get a bit closer to this one on the regulatory front to be able to get some comfort on what's going to happen here.
I know, and we might put it out there, and we put it out there when we post it. Is there anyone with specific expertise on the legal side who's looking at this?
Yeah.
I'd love to have a more detailed conversation.
Yeah.
Because actually, I'm looking at a lot of stuff now in our deep tech side, a lot of AI stuff.
Absolutely.
And at no point has anyone, as part of any applications or anything, made reference to regulation.
Yep, I know. And on that, there's a leftover story from a couple of weeks ago on the Central Bank of Ireland banning the use of ChatGPT. And I'm hearing that more and more, like big banks, like, in the US, Goldman Sachs, whatever, I think was one of them that said, sorry, you can't use that anymore. And it's just so easy to write client emails using that. So it's like, is it an employee liability thing where it's like, listen, sorry, that email went out, but I used ChatGPT for it, so it's not my fault.
Yeah.
Right?
Yeah.
So, but, ChatGPT 4 recently came out, and I don't think not everybody has access to it yet, but that's taking things even through the roof even more. So this is just so surprised how quickly AI is moving in the past year. After, 20 years of will we or won't we, it's just now in the last year that we've seen it. And I think maybe 2018 might have been Microsoft's first investment in OpenAI, which run ChatGPT and go back, a little ways. But now, what's his name? Bill Gates coming out and saying this is the most important technological development of the 21st century.
Yeah. And look, there's an argument to agree with that.
Yeah.
But like I see it that, I was in Future Finance in 2014 and we were doing online lending to students, and we were working with students with no credit histories effectively, and working on the data from the universities and kind of using that, you go to X university, you do X course, and you're likely to get 80% you'll graduate, and, your starting salary 6 months after university will be 30 grand or whatever. Great. It's all valid information to help us make credit risk or build a credit model on that basis. And at the same time, we were onboarding new universities that might be doing things like law and other kind of focusing on other specialist areas like that, whereby, those people are effectively being trained to go straight into a particular workforce.
Yeah.
So we measured the risk on them differently, but we were building that as we went. Like, there's no way or like in terms of making that an explainable model and with strict audit around it, we were effectively making it up or teaching ourselves it as we went in terms of the risk and how we were going to measure the risk on some of these things. There's no way that could have started in 12 months' time when there's a regulation on the other side. How can we build the models without the data, without trialing the data?
I know, building in the way they think it's going to unfold from a regulatory perspective. And so it is incredibly difficult to do because you're trying to build to cover a few different possible scenarios. And that is an incredibly difficult engineering proposition, but it's impressive to see in action. So fingers crossed.
Watch this space. We'll definitely revisit this
we
one
will.
Very soon.
We will. And it'll be one of our, definitely call to action here. Those that are experts in this AI Act coming in Europe, please
reach out. We'd love to have a chat.
Get in touch, and it'll come back to you, I promise.
Yeah.
All right. We'll leave it there for this week, dude.
That's it.
All right.
Enjoyable, as
Thank
always.
you. Adios.
Talk to you soon.
That does it for this week, folks. You can learn more about the stories we covered in the show notes on our website, moneyneversleeps.ie. If you like what you heard, please leave us a rating and or review on Apple Podcasts or Spotify, as it helps others to find the show. Thanks to Conan Brophy from Create Sound for mixing and editing this episode. Conan is an excellent media man to get in touch with when you're thinking about launching your own podcast. As for me, I'm an early stage startup investor focused on where fintech meets crypto and crypto meets Web3, and I lead the Techstars Web3 Accelerator. There are plenty of links in the show notes on moneyneversleeps.ie on how to get in touch with us, so don't hesitate to reach out. Finally, till next time, thanks for listening. See ya!
Money never sleeps.